Hi, you're back with Zoe from Business Basics. So we're going to pick up where we left off in terms of tutorial one. And we're just going to have a look at 10 ways in which we can control costs within a business. So we're going to go through them one by one, and hopefully it will just give you a really good idea of how you can actually manage your cash flow and make sure that actually your financial performance is what it should be within your business. So first thing is that you ensure that your vendor or supplier contracts do not exceed beyond a year. So basically that means, in brief, you need to renegotiate all your contracts annually. So you may need to consider adding that as a clause into your terms and conditions that you're going to have printed on the back of your invoice, because actually costs do rise, they do change, and it will just, if you do need to implement those cost controls or those price increases, it's not going to come as such a shock to your customers. So if you therefore add it into your terms and conditions, they will be quite happy, and they should be quite accepting, because you will know that actually if you've taken on that contract in June, in the following June we're going to renegotiate, we're going to sit back around that table, and we're going to have a look at how we can work together, and hopefully you will be able to squeeze a little bit of a price increase if necessary. So the second thing you can do is basically improve your bookkeeping and accounting practices. So right from the start of your business, you need to ensure that you note down your spending and revenue. Please don't be one of those businesses that turns up at their accounting at the end of the year with a carrier bag full of receipts. That's not effective, and it's not going to allow you to calculate those all-important ratios, which I've shown you how to calculate in a previous tutorial, and that will not allow you to analyse your financial performance at all. So make sure that you are keeping a well-organised and up-to-date record book and of all the costs that you're incurring as a business, as well as all the revenue, because it will just make that accountancy process just that little bit better. So consider those two things. What you need to do is revisit your tax saving strategy. So the impact of taxes will depend on the type of business you are dealing with. So hiring a good financial advisor or accountant is paramount to making sure that actually you're getting the most out of your money. And quite often they're able to identify ways that you can implement savings in your business, or claim additional things against tax that perhaps you haven't thought about if you were filing for it. Now, of course, if you are paying for an accountant, there is always going to be a cost involved, but just be aware actually you can claim back that accountancy fee in the following year. So although you've got to pay up front, you will always get that money back. Technology is key. So I've underlined our online invoicing, just because I want you just to think about actually using something like QuickBooks. They're very effective at making sure that actually you are invoicing correctly. You can set up your own standard formats, so you can have your logo on there. It will generate order numbers for you, and it will ping it straight across into your customer's email address, as well as recording it within the financial system. So although you may think actually that's quite you're not ready for that expenditure in your business, actually giving you technology will help improve your productivity, because rather than sitting at hours spending time tapping into spreadsheets, actually something like QuickBooks would allow you just to at a touch of a button invoice your customers. And it'll also allow you to work on your phone. So when you're out and about, perhaps you've got 5 minutes wherever you are, and you've only got access to your phone at that point, you can still invoice from your phone. So it will give you a really good system to start from, that you will be able to use for your financial recording. So every businessman knows that an employee is efficient when the revenue per employee grows. So what that basically means is, in order for your business to remain productive, you just need to make sure that everybody is covering their money, in essence. So if you are a business with employees, you need to keep an eye on their productivity rate. Quite often employees who have been within the business for a really long time actually see a decrease in productivity. So it's just about working with them on how you can maximise their motivation, and keeping their performance as high as physically possible. Because actually what you'll see with large corporate companies is they will go through a management restructure. So they will identify that actually productivity is decreasing. They can't explain why, because the order book may be increasing, but it may be taking longer to get those products out to your customers. And what they quite often do at that stage is to give it a restructure, not only does that wake up your current employees, but also it will see that actually they'll see there's room for progression. So they'll feel, some of them will feel invested in, whereas it's a good opportunity to offer things like redundancy to people who should actually maybe be moving on from the business. Every individual in any business has a shelf life, so it's important that actually people don't become too comfortable, and you actually remove those who aren't underperforming and replace them with people who ultimately will work harder for your business and therefore increase productivity. What you may want to do is, if you are considering going down the realms of employing someone and you're not quite sure if you want to commit to them in a full-time basis, is maybe you want to think about hiring freelancers or contract employees, so that they may bring in a certain skill set to your business, but actually you're not committing to paying for them in the longer term, and it will reduce the cost of your overheads in terms of your wages and your salary bills. So just consider actually, what skills does your business need now? How many months are you going to need it for? And actually, that's a good way to be able to ascertain whether that person is a good fit for your company as well, so that you're then able to make sure that they are actually working as hard as they could be for you and for your business, and therefore that will increase your productivity. Because recruiting the wrong person in a business can take a huge amount of time to, one, remove them, particularly if they're a toxic employee, but two, at that point, actually your business isn't working at its maximum efficiency, so that will also have an impact on your productivity. What you want to think about also is just some other little tips, is recycle your stationery. And I know this may seem really obvious, but actually paper, in particular in administration roles, is one of the biggest costs. So using recycled paper and printing cartridges means your office is also going green. So before running to the shredder, make sure that actually you can use double sides. And I know it sounds very obvious, but quite often if we see a piece of paper, we will quite often just throw it in the bin. Well, actually, you may find that you will be able to halve your efficiency, lower your environmental impact, and actually just save yourself a little bit of money in terms of recycling your stationery. And keep an eye on your energy consumption. So if you're someone who has a bricks and mortar shop, for example, and you've got a couple of employees, it's always really worth just spending a couple of minutes and just putting stickers by the lights saying switch off lights. Make sure that computers are turned off completely at the end of the day and the screen isn't just turned off, or the computer's on standby, because actually this can reduce your energy consumption by 25%, which is a huge amount when you're paying high amounts of electricity. And just making sure that actually if you're using laptops, they consume approximately 90% less energy, and they are obviously a more flexible way of working. So when you are looking at IT infrastructure, just consider which type of technology you think will fit your business, and actually which will have the lower impact in terms of energy consumption for you. And also, don't be afraid just to renegotiate with your vendors. So just because you've got a really good relationship with your supplier and they're able to fit the bill in terms of what your business is looking for, make sure you keep shopping around, because becoming complacent, absorbing price hikes is all really bad business sense. So just consider actually identifying new ways of working with them. Perhaps you need to renegotiate your contractor fee every sort of couple of months. And just keep those costs as low as possible so that you can ensure your markup margin, your gross and net profit margins remain as high as possible as well. So, just to be aware, in case you don't manage your finances appropriately, you just need to be aware that there are actually two types of repossession. And again, I've highlighted voluntary repossession here. So there are two major types. So one is voluntary repossession, and this is where you give your car back to the lender, for example, because you can no longer afford to pay the repayments. You've identified very early on that actually you can't make that repayment month on month. Therefore, you perhaps live within your means, or perhaps actually your profit isn't what it should be, so you're just going to give it back, and that's known as voluntary repossession. And then you have involuntary repossession, which basically means that the lender can sometimes take the car from your property without permission, and this is what we always want to try and avoid. So as long as they do not disturb you or your neighbours, if it was a car, an example, they can basically just come along, grab the car and drive off with it. But what we don't want to happen is that we want to be in a position where we're in full control of our costs and our expenditure, and actually if we're not able to meet them, then we identify that and we voluntarily repossess any items which aren't deemed as necessary. if your car is repossessed, either voluntary or involuntary, the loan on the car is not cancelled, and that's really important to recognise, because cars, as an example in this particular slide, do depreciate in value. So there is a chance that unfortunately you may still owe a little bit of money on that car. So you may need to renegotiate with the lenders how you pay for that. But what you should see is a reduction on the amount on the loan that you have against the vehicle. But just be aware that just because you're giving back a car doesn't mean that the debt is actually written off. So just consider that before you take out the hire purchase agreement. And when the car goes back, there are a couple of options. They may sell your car or they may auction your vehicle. But as I say, that will be the contributing factor to actually your vehicle costs not covering your loan amount. And as I say, that will be the overarching reason why you may still have to pay the balance. So just be aware of that before actually taking out, as I say, that hire purchase agreement. Because what happens is we usually make really large purchases when we're feeling quite cash rich in a business. So when a business is performing well, and we actually forget ourselves a little bit, we get a little bit excited by the amount of profit we're making, but we don't actually consider what will happen if, for example, the business faces a downturn or a new competitor comes into the market and takes away our clients. So it's also important to recognise that repossession has a really negative impact on your credit. It's one of the worst things that can happen to your credit rating, and it will take your credit rating score a long time to recover. So make sure that you have factored in, actually, if you're taking your car finance over 48 months as an example, that you can actually pay for it, and you've accounted for that in your cash flow forecast for the 48 months. And late payments will also impact your credit score. So make sure that even if it's a day late, that these things will also really, really badly impact your effect of your credit rating. And that will have a knock-on effect both personally and from a business viewpoint in the future, if you ever wanted to achieve financing. And it does stay on your account for 7 years. Now, 7 years is a huge amount of time, and a huge amount of things can change over that 7 years. And that's even for voluntary repossession. So just be aware before making those large purchases on credit that you can actually afford them before you go ahead and drive off with that brand new shiny car. So we've talked a little bit about credit rating and how it's impacted, but it's just important that you actually understand what a credit score is, because quite often that's not talked about. So a credit score basically identifies how safe you are to lend money to. So Experian is one of the UK's leading credit checking services, and I'll put their link in the below in the video. But you basically have this table below. So you have very poor, poor, fair, good, or excellent. Now, based on whether you've had credit in the past and how well you've managed that credit relationship and how well you've kept up with payments will depend on where you sit there. And quite often this is determined by actually the rate of interest that you will have to pay back on a loan, as an example, based on where you sit on the Experian credit rating report. So if you've got an excellent, for example, and you've never had any debt, you've paid it off, if you've ever taken any hire purchase, perhaps you've made repayments early and you've cleared down the debt very quickly, then the chances are you're going to be able to secure a loan in future at a much lower interest rate than someone who has perhaps a poor or fair credit rating. So it is just really important to recognise that actually your credit rating, although it may seem like a really good idea that you purchase that vehicle right now, whilst you're feeling quite cash rich, it will have a knock-on effect in your financial future. So we're going to leave it there in terms of credit scores. I thought this tutorial would be split into two, but actually I think I'm going to split it into three. So if you enjoyed this and you want to learn more about business and personal finance, then please join me in my next video. Thanks, see ya.